Hey traders! Please listen to this before I say a word.
Price did not return to your order block because a breaker was sitting above it. The thing is, you probably weren't paying close attention to ICT when he was talking about his PD arrays, like the order blocks, the fair value gaps, and the breaker. Because the answer to why price did not return to your order block lies within the matrix. Notice how the bullish breaker sits above the bullish order block. What this tells us is this. After we've taken liquidity and shifted structure to the upside to form our long setup, when price finally does retrace back into the range, it's likely to find support at the breaker instead of the order block because it'll encounter it first, simply making the need to come all the way back down to the order block a waste of time.
Now listen, for you to use this strategy, you have to understand each and every terminology, how they work, how to identify them on charts, more importantly, their purpose in Forex market. When you ignore this, you will not make money using the strategy. Before I explain this strategy in a manner that every trader will understand, let's first of all understand these major concepts that were mentioned in that video. He is paying attention on order blocks and breaker. So, what is order block in Forex trading? An order block is an area where there has been a large concentration of limit orders waiting to be executed. Order blocks are identified on a chart by observing previous price action and looking for areas where the price experienced significant movement or sudden changes in direction. When trading price action, these areas are important to watch as they can act as turning points, influencing the future direction of the market. When a large number of buy or sell orders is concentrated in a particular price level or zone, it can create a strong level of support or resistance. As the price approaches these levels, these large orders can absorb the buying or selling pressure, causing the price to reverse or consolidate. Why are order blocks important? Order blocks can affect the market in several ways. 1. Price movement. Due to the large size of these orders, order blocks can influence the market price. When a big block of buy orders is executed, it can push the price up, while when a big block of sell orders is executed, it can push the price down. 2. Liquidity. Order blocks can change how liquid a market is because they are often big enough to absorb all the available liquidity. This can result in temporary imbalances between supply and demand, causing price volatility. 3. Market sentiment. Order blocks may signal the sentiment of large players in the market, who often have access to better information and are more informed because of this. Other traders will follow them, which drives up the price. Overall, order blocks are an important concept in price action trading and can provide insights into the behavior of institutional traders and the key levels that are likely to impact the price of an asset in the future. How to identify order blocks. Price action traders usually look at how prices have moved in the past on the chart to see where the market has reacted strongly. These reactions could be in the form of price reversals, consolidations, or breakouts. Potential order blocks are marked at the price levels where these reactions happen. Order blocks often act as support and resistance levels. If the price bounces off an order block more than once, it is seen as a strong level of support or resistance, depending on whether the price came from above or below. The more times that price returns to the order block, the weaker it becomes as a support or resistance level. When the price breaks through an order block level, the role of support or resistance reverses. For example, a broken resistance level can turn into a support level and vice versa. When this happens, you might wait for a retest of the level that was broken before entering a trade in the direction of the breakout. Before we get deeper into that, let's understand about mitigated and unmitigated order blocks in Forex trading so that we can understand the strategy. Mitigated order blocks. A mitigated order block is an area on the chart where the price has revisited and filled the institutional orders that originally caused the price shift. In other words, the liquidity within that order block has been absorbed. These areas are considered to be of less interest for future trades because the imbalance of orders has been neutralized. Unmitigated order blocks. an unmitigated order block is a price area where the initial institutional orders have not yet been fully filled. This means the price has not returned to this level to absorb the remaining orders, leaving an imbalance. These areas are highly significant for traders as they are likely points where the price will revisit to mitigate the remaining orders, creating potential trade opportunities. With that, let's now learn about a breaker in Forex trading, which will definitely make you understand the strategy fully. What is a breaker in Forex trading? In Forex trading, a breaker refers to a significant price level where the market breaks through a previous support or resistance level. When a price level that has acted as a support, a level where the price tends to find support as it falls, or resistance, level where the price tends to face resistance as it rises, is broken, it can signal a potential change in market sentiment and can lead to strong price movements. Let's go ahead and understand the liquidity and shift of market structure. What is liquidity in Forex trading? In simple terms, liquidity in Forex trading refers to the ability of market participants to enter and exit positions quickly and efficiently without significantly affecting the price. A liquid market is characterized by high trading volume, a large number of buyers and sellers, and narrow bid-ask spreads. On the other hand, a market with low liquidity experiences fewer trades, limited participants, and wider spreads. The level of liquidity in the Forex market can vary depending on various factors such as the time of day, economic events, and market sentiment. For instance, during the overlap of trading sessions between London and New York, the market experiences the highest liquidity due to the participation of two major financial centers. On the other hand, during holidays or major news releases, liquidity may decrease as traders become more cautious and hesitant to enter the market. With that, let's understand MSS. What is a market structure shift? A market structure shift, MSS, indicates a potential reversal in market trends, marked initially by a lower high in an uptrend or a higher low in a downtrend, followed by a displacement, a significant and rapid price movement that decisively breaks through a key market level. With that understanding, let me now break down that strategy because I know you will all understand. Before waiting for your unmitigated order block to be mitigated, kindly look at what happened before that order block was formed. In this case, there was a breaker. So, what will mostly happen? Price will consider reacting to that breaker without considering the order block, and this can make the price to reverse. This doesn't mean price cannot as well break the breaker and head to the order block. Well, it can, but always consider what you see before that order block was formed. Because it can be a reason why your unmitigated order block will not be mitigated. That's it, traders. Let me hope you have learned something from this video. Subscribe, like and share. Bye. I will see you in my next video.